Hello and good morning from Cape Girardeau, Missouri. This is the Retirement Playbook brought to you by Alspaugh Wealth Management. We're here with you every week, bringing you new episodes of the Retirement Playbook right here on YouTube or Spotify or wherever you get your podcast. And as always, I'm joined by Mr. Tony Shore. Hello, Tony.
Hello, Brock Alspaugh. Great to be here with you today. I'm excited about our show. Can you tell? I'm excited.
You're
I
excited?
really am.
Are you
Yes.
excited or are you excited?
I get all excited.
Yeah.
Oh,
There's this
I'm excited.
special Chris
Yeah.
Farley that Mr. Shore likes to do, and he does a very good job at it. You get a little sneak peek. There you go.
There you go.
Listen, this is a cool week, right? We've got the Masters going on. We've
Yeah.
got the tax deadline coming up. That's not
Yep.
very cool. I know a lot of people writing checks. They don't want to write to the federal government,
Right.
but you have to do it. It's part of what we do in America. So anyway, that's what actually we're going to talk about today, which is taxes and your retirement. We're going to talk about how you can take advantage of some things that might help you in retirement when it comes to taxes. So Tony, I'm super pumped. But before we get into the material, we've got to let the folks know about our website.
Yeah.
It's alspaughwealthmanagement.com, ALSPAUGH. It's right there on the screen if you're on YouTube. Wealthmanagement.com. So alspaughwealthmanagement.com. You can download past shows. You can look at different topics that you like to hear about. You can be specific. You can nail down exactly what you want to hear about. You can also order my book. It's called The Last Paycheck, How to Build Sustainable Retirement Income and Keep Those Paychecks Coming In. That's what the goal is. That's what everybody wants to do. And you can get started by ordering that book. Or if you're saying, Brock, I'm ready, I need help, give us a call. 573-332-7855, and we can get started on putting a plan together for you. That's what we've been talking about. You know, Tony, you know the deal. We've been meeting with tons of Southeast Health employees because they're the whole Mercy transition. Mercy's taken over. So, you know, it's one of those things where these people are saying, oh, gosh, I've got deadlines coming up. In fact, the deadline is Monday for those people to roll their money out. If not, it'll go to an IRA. It's not the end of the world. Now, if you had that voluntary after-tax line item, then you might be getting a payout that you didn't expect. But everything else is still eligible to get a rollover. So that's good and that's great. But the most important thing you can do to help yourself is to get a plan. And that's exactly what we've been doing for all of these folks that need help. Because now is a unique time in your career. You're not going to have this opportunity to be able to say, hey, I'm putting away all this money in retirement. And now I've got an opportunity to have some freedom to invest in some things that may be outside of the lineup that's available in the new Mercy plan. And I'm not saying going to the new Mercy plan is a bad idea, by the way. For a lot of people, that makes a lot of sense. But if you need a plan and you need the financial freedom to say, I want to invest in things that are outside of the IRA or 401k lineup, then you need to do something about it.
Well,
Again,
and I
give us a
wouldn't
call.
want to make that decision without talking to and meeting with somebody like yourself, a fiduciary who's going to look out for my best interests or your best, the person's best interests, rather than make a decision on their own going, oh, well, I'll just do this. Well, maybe there could have been something a lot more advantageous that could save them a lot of money down the road.
You know, I hear a lot of times, hey, what I'm doing is fine. I'm under control. I've got it. I'm taking distributions. I'm like, okay, well, what kind of distribution you take? As I need money, or I'm taking this much every month. Not realizing that what you're doing is detrimental to your long-term financial success.
Yeah.
You know, that's just one example. Being too conservative, being too aggressive, all these things come into play. Maximizing your Social Security, making sure that you're allocated correctly. Taxes, what we're talking about today, and it's a topic. Yeah. Are you doing the most tax advantage thing for yourself and for your future self? Okay. Those are the things that we'll talk about when we get together. So again, give us a call, 573-332-7855, or look us up on the web at alspaughwealthmanagement.com. All right, Tony. So our topic today, taxes and retirement. You know, when you get to retirement, you feel like, oh, okay, I've made it. Here we are. I've got total financial freedom. I've got freedom in my schedule and all of these things. And then all of a sudden you're going, oh, well, there's some taxes on these IRA withdrawals.
Yeah.
My Social Security is taxable up to 85% of it. And by the way, everybody's asked this question because it's in the news. Well, isn't my Social Security going to be tax-free now? No. Potentially could help with state taxes. In Missouri, if you make over $100,000, You're not going to have tax-free Social Security benefits. And that's not even permanent now, by the way, folks. That's just kind of what's been proposed. So there are some tax breaks. And by the way, if you're over 65, I'm sure we're probably going to cover this. I might be getting ahead of myself. But if you're over 65, you get a bigger standard deduction, right? So either you itemize your taxes, which means you list all of your deductions, and then there's the net income, and that's what you pay taxes on. It's called your taxable income. Or you take the standard deduction, which they allow, and you don't have to itemize all that stuff. And that standard deduction, it gets applied to your taxes, and then that's your net taxable income.
So the standard deduction goes up when you turn 65?
Yes, it's $1,950 more if you're over 65.
Okay. That's good.
Okay? Yep. So
That's
you get
good
a little
for retirees.
Exactly. So you get a little bit of break there, and then all of a sudden, by the way, at 52, you can contribute more to your 401ks, as we all know, and your IRAs.
Yep.
So on your IRAs, $1,000 more. But also at age 55, Tony, you can put an extra $1,000 in your health savings account. And I know we've had past shows about, healthcare and saving for healthcare. We've talked, you and I have talked about, hey, man, really maximizing what that HSA can do for you, not only while you're working, but in retirement. You can use it to pay all those medical expenses. You can use it to pay your Medicare premiums. You can use it, right? So why not build that little nest egg up as well, just like you would in an IRA or a 401k?
Yeah.
So anyway, you get to retirement and you think, okay, here it is. I'm here. I'm good. I don't need to do anything else. Well, there's some things you can do. We're going to talk about them right now. Okay.
Excellent. Yeah. And having a tax strategy is important. People might think, well, hey, I've already paid my taxes. It's too late. No, we're talking about in the future, not looking back at last year necessarily, but looking ahead, especially for you to minimize that tax burden in retirement, right?
100%, Tony. I mean, we all know taxes can cause anxiety. Okay.
Right.
I mean, let's just call a spade here.
Yeah.
But, Tony, with the right strategy, your regular check-ins with your financial services professional, things like that, keeping yourself updated, by the way, about legislative changes can help you move forward with confidence. Just to know that your net after-tax income is going to be this dollar amount, because that's what you've planned for your entire, working career. So I'm going to reference a Kiplinger article titled How 13 Types of Retirement Income Get Taxed. So we'll give a little bit of an understanding here, Tony. And it describes how many of our most common retirement income tools are taxed and how you can build a strategy that handles your tax requirements.
Excellent.
Okay? All right. So the article begins by addressing traditional 401ks and IRAs. We know that you got a tax break for putting money into these accounts, these pre-tax accounts, these traditional IRAs and 401ks. However, that net, that money that goes in, it grows and grows and grows. And your contribution that you put in, and then all of the growth when you retire, is fully taxable. Okay. At ordinary income rates. So people say, well, what about capital gains rates on my distributions? No, you don't get special tax treatment on IRA distributions. It's taxed as ordinary income. Okay. So, people think, okay, the growth on it and whatever. No, it's going to be ordinary income. So plan on that. All right. That's the first and foremost, is that it will be taxed, and it will be taxed at ordinary income. Okay.
Yeah.
Now, don't forget about, and this is easily done, Tony, is that you forget about the tax savings you got by putting the money in.
Right.
So, I mean, everybody knows, if you've listened to any of my shows or done anything, if you heard me before, I'm a huge proponent of the Roth. Okay. But let's not forget the tax savings that we got on our traditional by putting the money in pre-tax, especially for folks that, let's say you're a high income earner, okay, and you put the money in when you were making $500,000 or $600,000 a year, and then you're taking distributions out when maybe you're only, your retirement income is maybe only $200,000. Well, you won. Like, you won that game, right? I mean,
right.
That's a good thing. But anyway, so as it pertains to traditionals, the article also tells us that there's required minimum distributions. So required minimum distributions, you might hear the term RMD, and those begin at age 73 for those with traditional IRAs and 401ks. If you stay on the job a little bit longer, you may be able to delay those required minimum distributions from your employer's 401k until you are officially retired, as long as you don't own more than 5% of the company that you're working for. So there's a little bit of a break there, Tony.
Yeah.
And then also, thanks to the 2023 Secure Act 2.0, okay, the required minimum age rises to 75 in 2033.
So for me, it'll be 75.
That's correct. That's correct. And for me, it's going to be 75. And hopefully maybe it'll be even later.
Yeah.
And there's a conversation around this that people say, well, okay, you don't have to take the money out. And in reality, like, that's why you save this money, right? So the RMD being is to use,
is to take out at some point, right?
Yes, to supplement your Social
Typically,
Security and other pensions, right? I mean, that's what you've saved this money for.
Yeah.
And so viewing this as a problem can sometimes be, first world problems, I guess.
Yeah, people are like, oh, that's not a problem. Well, it can become a problem if it bumps you into a higher tax bracket, affects your eligibility. It could increase your Medicare costs. I know these things because you've said that before.
Yeah, I have. And, that evil Irma, it's like the wicked witch
Irma,
of the
old Aunt
wicked
Irma.
witch of the East or West or whatever. So
she was evil.
Yeah. So that's that tax on your Medicare premiums that if you make too much money. Anyway, moving along. So I do want to make two extra points here on this, Tony. One is that people ask me this question a lot. Well, what tax rate do I have to pay on my IRA distributions? And that really depends on how much total taxable income you have.
Yeah.
And you can look at, say, for example, tax rates right now. And
it's going to be whatever your ordinary tax rate is, right?
That's correct. So if you add up all of your taxable income, and let's say it's $100,000, okay, the first $20,000 is going to be taxed at 12. Then your next tranche is going to be taxed at 15, and then 22, and then 28. So it just kind of goes up. So what you'd have to do in that particular case, if you really want to know what your rate is average those out to get what we call the effective tax rate. Okay. So on $100,000 of income, and don't hold me to this, I'm taking a guess here, it's probably going to be somewhere in that 15%, right? On 100,000, if you average it all out as far as how much money you have in each tier. And that's just federal. So you got state taxes on top of that. But that's the answer. I get that question a lot. Well, what tax rate? Well, it depends on how much income you have total. Okay.
Yeah.
Now remember, Roth IRA distributions don't count towards how much of your other withdrawals will be taxed at. Okay.
Which is handy.
Oh,
it doesn't count as taxable income or affect that number at all.
You know what else doesn't count? Distributions from a permanent life insurance policy that you're using to supplement your income. This is a discussion for much, much later on, or a different show altogether. But if you're saving money like a Roth IRA, and this is what I'm doing. I've told you this before. I'm full disclosure here that, I'm setting myself up for a tax-free retirement. I'm maximizing how much me and my wife are putting in Roth accounts.
Right.
And then I'm actually overfunding a life insurance. I need life insurance, right? Because I have a family. I've got a business. I got to take care of people if something were to happen to me. So if you need life insurance, that might be something to look at if you have some extra income to be able to put into a life insurance policy and overfund it, and then take distributions from that cash value in retirement to supplement your income. Those are not taxable either if you set it up right. So anyway, those are a couple strategies and tools that you can use too that would help you in your tax situation in retirement. So,
So what about Social Security? What about the tax implications for Social Security? You alluded to it earlier, but that's what people want to know is, can my Social Security be taxed, and how much of it gets taxed?
More than likely it will be. Another advantage of setting up with the Roth IRA and using the cash value life insurance, because those two things are not only not taxable, but they don't go towards your provisional income. So, Tony, let's talk about provisional income. In 2024, if your provisional income is less than $25,000 or $32,000 if you're married, your Social Security benefits will be tax-free. Okay? And so what is provisional income? Provisional income is all of your income and half of your Social Security. So if you're working or if you're taking distributions from IRAs, that's taxable income, plus half of your Social Security benefit. So if those things add up to be over, under 32,000 for a married couple, your Social Security is tax free. That's pretty cool, right? That's it. But the problem is, Tony, these levels have not changed,
Yeah,
and
they're
they need to
pretty
be
low.
changed.
I mean, hopefully people, a couple is making more than 32,000 or living on more than $32,000 a year.
Exactly.
Yeah.
Okay. So that is provisional income, and again, Roth IRA distributions don't count towards your provisional income. Now, if your provisional income is between 25,000, or let's just use a married couple here, if it's between 34,000, so you went over the limit. If you went over 32,000 and you go up to $44,000, half. Okay. So again, we're talking about provisional income, which is your income plus half your Social Security. It starts out at 50%. 50% of your benefits will be taxable. Okay. Then it goes up to 85%. So it's really, small numbers here, but it starts at 32,000 for married couples, goes up to 44,000, starts at 50% and goes up to 85. So if your income is 45,000, to make this real easy, if your income is over 4,000, 85% of your benefits will be taxable.
Yeah.
That's it. That's the bottom line.
At your normal tax rate. It's not like they'll be taxed at 85%. It's 85% of your Social Security is subject to federal tax.
So why don't we just get our little drawing board out here, Tony? It's an imaginary drawing board, and let's say that for easy math, $1,000 is your Social Security benefit. If your provisional income is over 44,000, 850 of that per month goes to into the calculation as to how much of your total income is taxed. And let's go back to my example that if you made 100,000, if your effective federal rate was 15%, so you'd take $850. So that's how much of our Social Security benefit is taxable every month, and multiply it by 15%. That's it. That's the amount of tax that you would owe on your Social Security benefits. Okay? Clear as mud? I mean,
no, that's great. I just don't understand why on that imaginary whiteboard, I see the numbers you went through, but why did you draw a chicken? I see. I don't understand why you drew a little cartoon chicken up there as well. Anyway, you're really good on the drawing board there.
Thanks. Yeah. So anyway, how about I do this? So I can do kind of hard to do when it's reversed. Anyway.
Yeah.
Okay. So that kind of covers Social Security, right? And hopefully you have a better understanding of how much of your Social Security benefit. So basically, the bottom line is, guys, if your provisional income is over 44,000, which is half your Social Security benefit and your other withdrawals and other income, then 85% of your benefit is going to be taxable. And what I have been saying for years is that I don't know when the last time these numbers were changed, but I know it's been at least 15 years, at least. Okay. These numbers need to go up.
It's been longer than that. I read somewhere that they haven't changed these numbers in a long time.
We need to get our statistician. I don't know who it is, but we need to get him or her and look that answer up.
Yeah.
Most shows have that, right, Tony?
Yeah. Yeah. Oh, yeah. They have somebody waiting in the wings that could just punch that up for us.
Exactly.
Yeah.
So anyway, those numbers need to change, man. I mean, we're talking about inflation over the last few years. Come on, these numbers need to change. Let's go, Congress. Do something about it. So yeah, good luck with that too, by the way.
Yeah, inflation numbers ticked up again. Actually, I read this morning. So
yeah. Okay, you ready to move on here, Tony?
Yes. Yeah. What's next? So we're talking about taxes in your retirement, how your retirement income can be taxed, what you need to look out for, like traditional IRAs and 401ks versus Roth, and how Roth and cash value life insurance policies are not taxable income in retirement, and Social Security can be taxed. What's next?
Yeah, so we're going to talk about after-tax money, right? Okay. So you have buckets of money. You probably heard of the term buckets of money.
Yep.
So when we have buckets of money, what that is referring to is different tax buckets. So here's one bucket. That is your retirement account. So that's your traditional IRAs, traditional 401ks, where you put money in pre-tax, so you got a little tax break. But then in retirement, those distributions will be taxable.
So it's tax deferred. So that's a tax deferred bucket.
It's a tax deferred bucket. Yes. Thank you. I did misspeak there. So anyway, the point is that money will be, those distributions will be taxable. Then you have the Roth, which is going to be tax free, right? If you set it up correctly and
I
do it
like the
correctly.
tax-free bucket.
We all like the tax free bucket. Now, the price you paid for having tax free bucket of money is that you funded it with after tax dollars. So you paid the taxes on it now for all of the growth and your contributions to be tax free in retirement. So that's awesome. But that's a retirement bucket. And then the third bucket is so we've talked about tax deferred, tax free, after tax. So it's a bucket of money that is not necessarily all geared towards retirement. It doesn't have the strings attached to it, like 59 and a half. You can't take a distribution until you're 59 and a half from your retirement accounts. Otherwise, there'll be a 10% penalty. Even on the Roth, they have a 5-year rule. So, I mean, there's rules and strings attached to retirement accounts. But because of that, you get the benefits, right? And so anytime there's a benefit, there's always a cost, and that's the cost. So the after-tax account is just you putting money in, say, your emergency fund, right? So you have this emergency fund that is 4 to 6 months of your expenses set up in the bank account to where it's accessible to you. Outside of that, what I recommend a lot of people are doing is if you're fully funding your retirement or funding it to the level that you need to, and you have your emergency fund, let's start an after-tax investment. So you open up a brokerage account when you're in your spouse's name, you put money in it every month, and it accumulates. As you accumulate, and as there are distributions, or maybe they're selling and gains off and those kinds of things, that you pay taxes kind of as you go. Okay. And so that is not necessarily a bad thing, because a lot of times what you can do is set these accounts up to where maybe they pay out capital gain taxes versus ordinary income taxes, Tony. So there's some things you can do strategy wise to make that work really well too. So, but that's your after tax bucket of money. You don't have the strings attached, but you don't necessarily have the tax benefits that you would have with retirement accounts. And that's okay, because tax diversification is is very, very important. I wouldn't say it's quite as important as your asset allocation, but tax diversification is definitely something that is very important. Okay. Yeah. Because in retirement, you can use this money as well. So people that, for example, have, company stock and have the ability to do what we call net unrealized appreciation, you can do that and take advantage of capital gains rates instead of ordinary income rates.
Right.
Huge things you can do.
Yeah. And speaking of that, what about stocks, bonds, and mutual funds, traditional investments? So if I own some stocks or have a stock portfolio, how are those taxed?
So again, if you meet the criteria, so there are some, we talked about not having strings
you can get in the weeds, right?
Yeah, you can get in the weeds. But if you hold it for more than 365 days, Tony, and then you sell that stock, it's going to be taxed at capital gains rates, which are favorable, right? 0, 15, and 20. Those are the different levels. But and that the amount of level that you pay is based on your income. So of your ordinary income. So you could have it to where there's 0 capital gains if your income is a little bit lower. But worst case, if your income's high, 20% is the highest versus 35. So, that's a significant, savings in taxes. So
sure.
Again, it's a huge advantage. Plus, like I said, Tony, you've got this after-tax bucket of money. Your emergency savings is taken care of. But you can use this, man. You can use it for, before you're 59 and a half, you could invest and save, and, maybe you're saving for a house in Florida or wherever. And, the point is that you can use it to fund your midterm and even longer term goals and pay. Yes, it's after tax, but you can do things to help yourself there as well. Investing in things that will pay capital gains taxes, or maybe it's tax-free through some municipal investments. So there's some things you can do to help yourself there too in the after-tax account. That's the bottom line.
Yeah. Good to know. And so, obviously if you have a loss, you might be able to write that off. If you have gains, you're going to have to pay some taxes on those gains. That's what you're saying.
Yeah, absolutely. So you can use the losses to offset other gains that you might have.
No, that's good.
You could do that. You could, and by the way, The 20% rate starts at $518,000, Tony. So if you make over that, it's 20%. But up to that level, it's 15% unless you're below $94,050 for joint filers, and it's zero
Wow.
capital gains. Now that doesn't count, things like the 3.8% surtax on net investment income. So there are some
Sure.
additional taxes that might come into play for you,
Yeah.
but you've got to talk to your tax advisor to fully understand all that as well.
Yeah.
Okay.
So if you sell at a loss, though, that
Yes.
offsets the capital gains. So
If elsewhere, yeah. So if you had an account, after tax brokerage account, and your net was, I don't know, $3,000 loss, but you had a $3,000 gain because you sold some real estate or whatever, yeah, you can use that to offset it. Okay.
yeah, and obviously, I think potential tax implications that you've been talking about, Brock, they can get complicated. So
Oof.
that's where our listeners need to be working with somebody like yourself alongside tax professionals, because you're going to have a plan and a strategy for them and can help them understand these things and make sure they're working with the right type of tax professional who does look at those things and understands them.
Yeah, for sure, man. If you're not considering and accounting for taxes in retirement, it's almost as detrimental as not accounting for inflation, right? So if you're
Right.
saying, "Oh, well, $3,000 a month, I can live off of that." Well, can you do that in 20 years? So the whole thing about taxes is real. We know that we're enjoying some lower tax rates right now through the end of next year, but start of 2026, these rates are going to go up. Have you accounted for that? I mean, that's short term, man. That's not something like 10 years down the road. That's happening here in 18 months. So, are you accounting for those additional taxes that you'll have to pay?
Yeah.
So, yeah, 100%, Tony. It's just like a lot of things. There are so many rules. There's so many things that you could take advantage of. That's why people need to work with a professional, because you just don't have the capacity, or you're not, if this isn't what you do, then it's
Right.
not what you do. So anyway, the
Right.
point is work with a professional.
Yeah. So pretty much, I think you've covered the gamut of income in retirement. I mean, maybe the one thing we haven't touched on yet would be annuities. And I know that people sometimes have annuities in their financial plan. So, what about that? Some people use them to generate income. So, how are
Mhm.
annuities taxed?
So annuities are what we call, they're taxed in using a principle of what we call LIFO, last in, first out, which means that you save money in an annuity. If it's deferred annuity, it's going to be tax deferred. So when you take it out, they're going to make you pay. They're going to give you your gains first, so you got to pay taxes, ordinary income taxes on those gains first, and then you can get into your principal, and obviously that's tax free. But when you're talking about an income stream, which a traditional annuity would be for, is that they have certain ones that might be an immediate annuity, so you have exclusion ratios. The point is that there are different ways to pay taxes on annuity income. It
And
just
you need to
depends.
take that into account when you're setting up an annuity to
Oh
say,
yeah, for
hey,
sure.
how is this going to be taxed? And that's something
Right.
you look at for your clients. If that's something they have, you
Oh,
you,
for
you look
sure.
at it, or something that might fit their needs, you're going to look at the tax
But
implications.
look, if you're talking about, here we are, talking about income riders on annuities, or are we talking about annuitization? Or are we talking about using exclusion ratios? Or are we talking about ordinary income? There's just so many things that go into this. But yeah, annuities are a great tool to use to provide that retirement income, right? That's
Yeah.
what they're designed to do. I know that sometimes they're forced into things that's not what they're meant to do, but that's at its core. That's what annuities are to do, is to
Yeah,
provide income,
the good kind of annuities, like a fixed index annuity,
right?
that can be used for income in retirement or lifetime income, and so and then there's different ways that can be taxed depending on how it's set up. But if I understood you correctly, a lot of annuities, if they're a deferred annuity, then when it's tax deferred, so when you take the money out, any gains are taxable at regular interest rates.
Regular ordinary income.
Yeah,
Right. Yeah.
income
Yep.
rates, but the principal you take out is not taxable.
That's correct. That's correct. So if you put 100,000 in, it grows to 110, you're going to take out the $10,000 first. If you take a distribution, they're going to make you do that. That is going to be taxed ordinary income, but the 100,000 would be tax free because it's the money you put in on an
Got
after-tax basis. Yeah.
Makes perfect sense. Well, we've covered a lot today in our half hour, Brock. You ran through a lot, but there are a lot of aspects to this. There's a lot of minutia. So if our listeners have questions or they want an opinion on where they're at, how can they get a hold of you?
Yeah, look us up on the web, right? It's alspaughwealthmanagement.com. You get a button right there at the top that says contact us. You can set up a time to meet with me. Otherwise, you can give us a good old-fashioned phone call, 573-332-7855.
All right. Well, Brock, great show today. That does it for today's episode of the Retirement Playbook with our host, Brock Alspaugh.